Hi everyone, it's Susan, South Florida real estate agent. Today we are lucky to have Chris here with us. Chris is a mortgage broker. He has been doing mortgage and providing advice for many first home buyers and investors. Happy to have you here, Chris.
Thank you, Susan. How's everything going?
Good, good.
Perfect.
Today we would like to learn FHA and how to live free while gaining the equity, like rich people do.
Okay.
So who needs to hear about this? If you are entry-level investors, you want to invest, but don't have enough money to buy multiple rentals, this is for you. Okay, so Chris, can we start from talking about FHA and then FHA 203K and what are the benefits?
Yep, let's go into it. So it's great that you mentioned FHA because the first thing most investors, when they hear the word FHA, they say, well, I can't do it because I don't want to live in a home as a primary residence. So I'm going to show and give you guys the example of what you can do to, acquire an FHA property using that low down payment and be able to use it as an investment property in the future. Pay attention to the word and the verbiage that I use because it's going to be important. So FHA, like I said earlier, it's for primary residence home owners. Okay. Usually when you're looking to buy a home and you're looking to live in a home, banks allow you to put a lower down payment if you're a first time home buyer or buying as a primary resident. The reason being is because you're seen as less risk. Okay. If you're using a home as an investment, that means technically you have another home or rental or apartment that you're living in. And the money that you have is going to go towards that first and then investment second. So if you're buying an investment property, the banks see it as more risk. So that's why they require you to put a higher down payment. And that kind of puts a few investors on hold, especially first time investors, because they're looking to get into invest in a property, but they don't have the 20% up front. So where FHA is great and conventional as well, but FHA in this topic is great is because FHA allows you to buy quote unquote an investment property at 3.5% down. How will we do that? There's many ways. FHA has different products. They have, the FHA, one-time closing loan. That's a different topic that we should discuss later. They have the standard FHA 203B. That's the standard home purchase you're buying a primary residence or multifamily. So now when we talk multifamily, FHA has this product where you can, buy a property that has two doors or 1 to 4 doors, different entries, and you can buy it as a primary resident and use it as an investment property and collect rental income, and then still only put that 3.5% down. And then the topic today we're going to talk about is the FHA 203K rehab loan. Okay, that loan actually has two components. It's going to be the FHA 203K limited rehab loan, and then the standard one. Limited allows you to rehab a property of up to $35,000. 35 to 50 here and there, 35 to $50,000, and they don't allow any structural rehab going on, so you can't really change the roof or anything that is or the walls as far as the structure of the property, but you can do rehab on the property. And then they have the FHA 203K standard loan. The standard one, anything above 35 to $50,000, you're able to do rehab on the property and finance the rehab into one mortgage. So that's where it gets a little complex. So I know I said a lot, but we're going to go over it in this entire zone so more people are interested, especially investors, because when we talk about fixer-upper and fix and flip properties, and you're able to finance the flip rather than having to finance the rehab rather than having to pay for the rehab, that helps you keep more capital in your pocket.
True. So yeah, this sounds very good. What are the qualifications? The qualification to apply the FHA?
Yep. So one, FHA, this is once again a verbiage. So FHA, you have to not have a FHA loan currently. You don't have to be a first-time home buyer. You can't have a FHA. You have to be your first FHA loan or only FHA loan on your credit. So that's one, you have to start there. You have to apply for a mortgage. If you want that 3.5% down, most banks, FHA themselves, they set a guideline for 580 or higher credit score if you want 3.5% down. Some banks do differently. Our bank here, we have 580 or higher. And then if you're looking into, if you have lower than 580, if you have 500 or higher to 580 credit score, your down payment is going to be 10%. So that's the credit requirement. You have to have stable income. You have to produce income. So this isn't one of those loans where you can show no docs. We have those products here, but FHA doesn't allow that. So you're either W-2, meaning that you're working for a company and receiving a W-2, or you're self-employed and you're able to show your taxes as well. And then you have to be able to have the assets for the loan, meaning that you have to have the down payment and closing cost requirements. And yeah, that's about it. As long as you're applied and qualified for a mortgage and aren't delinquent on any federal debt, you should be able to get an FHA loan.
Sounds pretty good. So the credit score 580 or above. If your credit score is less, still okay. You just need to put a little bit more down payment, right?
A higher down payment, you're going to see they're going to have a little higher mortgage insurance premium for that category of people. But once again, if you're able to acquire that property, it's still going to be better off than going for an investor product that's going to allow 20% down. So you're still winning there.
Yeah, sounds good. So it sounds like it's so too good to be true. Is there any limitation?
There is. So FHA, you have to live in the property for at least 1 year. Okay.
Okay.
So that's where it's going to be the limitation. FHA, because it's for primary residence, they want you to live in the property. So that's where investors kind of get a little, a little confused or get a little scared to use the loan, because a lot of times they're trying to, especially if we're looking to use that 203K rehab loan, you're trying to fix it, catch the equity, and sell right away. But what FHA is going to do is they're going to make sure that you live in the property for a year or I mean, minimum a year. So that's going to be to catch, I guess not catch, but that's going to be sort of, one of the downfalls or disadvantages to FHA. So if you can hold the property for a year at least, it should be a good product for you.
And also, if you live there for 2 years, then you don't have to pay the capital gain tax, right?
That's another thing. So it's your property tax. You're paying property taxes on it. So, and you're using it as a primary residence. So if you do have any appreciation on the property, at that point you'll be able to avoid that capital gains tax.
True. So let's see if the buyer see a foreclosed house at 350,000, for example, and let's say the repair cost is roughly 35,000, and they want to use the FHA loan. Let's say in the market, the market price, the future value can possibly for 425,000. So this buyer see there's a good potential to leverage FHA 203K. How do we make this work, and what is the process?
Yep. So let's say you're reaching out and you're looking for a property that's foreclosed, and now you're about to put an offer on it. Either you're reaching out to the bank or the realtor that's listing the property. So first things first, we're going to get a contract in place. And that contract is for $350,000, and then now we're going to assess how much rehab needs to be done. Okay, so you should probably reach out to an appraisal, and appraisal will understand that they're trained as an FHA appraisal, so they'll go out there and they'll tell you this is the future appraised value for the property if X, and X gets finished. Let's say, for the example, they're saying that the roof is repaired, and a few windows replaced, or repainting, touch up, and you're seeing that, and then they say that the future value of the property is going to be around $425,000. Now, here's where the fun happens. This is where you reach out to an FHA approved contractor, and then you look up some work. You look up how you're trying to figure out how much the repair cost is going to be. So in this case, let's say we got lucky, we were able to find contractors that's able to fix up the property for about $35,000. Now what they're going to do is the contractor is going to know that we're using an FHA loan, and they're going to get paid using a draw. A draw means that they're not going to get paid in lump sum. FHA, what they like to do is they like to see the work done. So the contractor needs to submit his or her invoices to the FHA, so that they can see how much the work is going to cost. Those invoices to the FHA, they call them bids. So they're going to submit it, and then they take a draw out, whether it's bi-weekly, however they're getting taking the money out, or the FHA allows it. They're going to send it, and then it adds up to let's say $35,000. Once the work is completed, in a perfect world, it's going to be completed within the time frame of the contract. But chances are you're going to it's going to take some time. You don't know, things happen, whether the contractor can be late on another job, can come behind. It's dependent on the contractor. They are FHA approved contractors, but they're not FHA contractors. So, you kind of are dealing with someone that you need to have possibly good recommendations or good reviews. That's what I would say. So let's say the work is completed, and we're looking to buy. And now what's going to happen is we're going to go based off of you're going to put a down payment based off of the sales price plus the repair value. I mean, the repair cost. So if we're taking out that $35,000 draw, we took out a property. The property was $350,000. So the minimum down payment requirement is 3.5% of that. So 96.5. You're looking at a loan amount of $337,750 plus the $35,000 that was contributed to the contractor's pay or labor, and it's going to be around $372,000. And then now what we remember is the appraiser said that the value of the property is going to be around $425,000. So you look at that, and you got yourself $50,000 of appreciation in the property that you're going to get as soon as you close on this property. Once the appraiser goes back out there, you're going to be good to go. The appraiser has to go back out there again to make sure the work was completed. And then that subject to appraiser turns into an as is. So you got that equity right away, and you're only having to put 3.5% of the loan amount or the purchase price down on the property.
Sounds amazing. So you only need to pay the down payment based on the contract price. So all the repair costs can be combined with your loan, and you walk away with a $40,000 equity at closing. Not even live 1 day yet. You got a 40,000 equity, right? That sounds really good. So a lot of information today, and thank you, Chris, for sharing. If you would like to learn one step further, please reach out to Chris on Mortgage, and you know where to reach me. If you want to buy an investment property or you want to buy your first home. Thank you, Chris.
Thank you, Susan.
Okay, bye.
Yes.